Coca Cola Femsa beat consensus across the board this morning. I mean, Q2 revenue came in at 76.3 billion Mexican pesos, and EPS hit 0.37 pesos.
Yeah, and with management reiterating their strong full-year guidance, the stock is already up like 3% in early trading.
Exactly. So a really solid reaction from the market. But for you listening, the mission of this deep dive is to figure out exactly how the world's largest Coca-Cola franchise bottler by volume actually pulled this off.
Right, because they're balancing a really struggling home market in Mexico with this absolute explosion of growth in their emerging South American territories.
Yeah, and the sheer scale is just wild. I mean, they sold 1,071.8 million unit cases in just 90 days. That is a 3.5% increase.
It's a mountain of beverages.
It really is. Okay, let's unpack this. Because to really understand this Q2 earnings report, we have to start with the invisible macroeconomic force that is basically distorting every single number on their balance sheet.
You mean foreign exchange rates?
Exactly. Foreign exchange.
Yeah, it's the defining feature of operating a multinational company in Latin America, you know. When your business spans Brazil, Colombia, Argentina, but you report your consolidated financials in Mexican pesos.
Your financial reality just gets completely warped.
Completely. The daily fluctuations of those local currencies against the peso change everything.
It's kind of like looking at their performance through a warped carnival mirror. You have to strip away the FX to see the actual operational muscle.
That's a great way to put it.
Like consolidated revenue increased 4.7% to that 76.3 billion peso mark. But if you calculate it on a currency-neutral basis, revenue actually grew 6.6%.
Right, and operating income increased 9.1%, but currency-neutral, it was up 11.1%.
So the strong Mexican peso is a massive drag. But here's the thing I really want to ask you about. How much of a drag is that strong peso, and why are they still reporting higher gross profits despite it? Because their gross margin actually expanded 180 basis points to 47.1%.
Yeah, even with surging global aluminum costs. What's fascinating here is the mechanics of how currency impacts the cost of goods sold versus revenue.
Okay.
It's a difference between translation and transaction.
Right.
So you described the translation drag perfectly. Converting weaker foreign sales into a strong home currency shrinks the reported revenue.
Makes sense.
But on the transaction side, a strong operating currency suddenly becomes this massive asset. KOF buys a ton of raw materials, specifically PE resin for plastic bottles and certain sweeteners in US dollars.
Oh, I see. So the appreciation of their operating currencies against the dollar gave them, like, sudden purchasing power.
Exactly. They effectively got a discount on their primary raw materials simply because their local money was stronger.
Wow.
But, I mean, we can't just chalk up that 180 basis point margin expansion to pure currency luck.
Right. They have to be doing something proactive.
They are. They actively engineer their cost structure through raw material hedging. A company this massive doesn't just buy sugar or plastic at whatever the spot price is on a random Tuesday.
They use financial derivatives, right?
Yeah, forward contracts to lock in pricing months in advance.
So they're essentially buying insurance against commodity spikes.
Basically, yeah. By locking in lower costs for sweeteners and pait early, and then layering that on top of the favorable currency exchange rate, they built a fortress around their cost of goods sold.
So even with aluminum prices spiking, their gross profit was protected.
Completely protected.
Well, that distinction clears up the global picture. But when you look under the hood, that consolidated margin expansion kind of masks a severe geographic divide.
It really does.
Because their home turf is facing some serious friction, right?
Right.
While South America is just booming.
Yeah, the regional disparity is stark. If you isolate the Mexico and Central America division, you're looking at a market dealing with really intense headwinds.
Yeah, I mean, volume in Mexico and Central America barely crawled up 1.4%. Revenue is basically flat up just 0.3%.
And the operating income outright dropped 7.0%.
7%. That's a big hit. The CEO, Ian Craig, noted the, quote, challenging consumer environment and the effects of an excise tax increase.
Right, and beyond just consumers buying less soda, their operating expenses, specifically freight and marketing, completely outpaced their revenue growth.
Which caused a margin squeeze.
Exactly. It's a classic demonstration of what happens when a highly optimized distribution network hits a sudden volume slowdown. They have massive fixed costs, bottling facilities, fleets of trucks.
Right, you still have to pay the driver and the fuel even if the store is buying half as much product.
Precisely. Those fixed costs suddenly eat up a larger percentage of the revenue.
But here's where it gets really interesting. You look at their South America division. And the numbers are just insane.
Night and day.
Volume across the region surged 6.9%. Colombia delivered a staggering 17.7% increase. Brazil was up 5.2%.
Yeah.
And operating income skyrocketed 46.5%.
Huge numbers.
But wait, I have to push back a bit on this South American miracle. If you dig into the footnotes, that 46.5% jump includes a 265 million peso insurance claim in Brazil.
Good catch. Yes, it does.
And this quarter coincided perfectly with the World Cup, which always drives massive, temporary beverage sales. So is this South American boom actually sustainable, or is it just inflated by one-off payouts and soccer euphoria?
It's a totally fair question. You absolutely have to filter out those one-off events. That 265 million peso injection definitely distorts the headline growth figure.
Right.
And the World Cup was undeniably a short-term tailwind. But if you mathematically remove that insurance claim, the underlying structural strength there is still undeniable.
So the core business is still outperforming Mexico.
Categorically. Look at the gross margin in South America. It expanded by 220 basis points. You don't get that from a temporary soccer bump.
Where does it come from then?
Masterful revenue growth management or price pack architecture.
So they aren't just selling more liquid. They're manipulating how it's packaged and priced.
Exactly. In Brazil and Colombia, they pushed favorable mix effects, meaning they heavily promoted single-serve formats and returnable bottles.
Which carry a higher profit margin.
Exactly. And they found labor and warehouse efficiencies to offset higher freight costs. So the miracle isn't just the volume, it's the commercial discipline to capture margin on that volume.
Makes sense. But South America wasn't a total success story. There's Argentina.
Ah, Argentina. Yeah.
Volume declined sharply there, obviously driven by hyperinflation. But the financials show something weird. Despite selling fewer beverages, KOF recognized a 74 million peso gain in monetary positions there. How does that work?
It's the mechanical reality of hyperinflationary accounting.
Okay, break that down for me.
So, when inflation is running at extreme triple-digit rates, cash loses purchasing power daily. But if a company holds local liabilities like local currency debt, the real inflation-adjusted value of that debt shrinks rapidly, too.
Oh, wow. So their debt devalued faster than their assets.
Exactly. So accounting rules require them to record that loss of debt value as a non-cash gain.
That is wild financial engineering, which actually transitions perfectly to how management handles the corporate wallet.
Right.
We've talked about operations, but let's look at capital allocation.
Right.
And speaking of operations, Ian Craig didn't even open the call with the numbers. He opened with condolences for the victims of the earthquakes in Venezuela.
Yeah, he specifically addressed the impacted communities, the first responders, and the local KOF employees there.
It really grounds the conversation.
Yeah.
Like, this is a physical distribution business. You can't virtualize a bottling plant. When you have 90,000 employees, you're going to intersect with natural disasters.
It highlights the human element and the physical footprint required to generate these numbers.
Absolutely. But when we look at the financial architecture supporting that footprint, they are making some aggressive moves.
Very aggressive.
Like, their comprehensive financing results showed a much higher expense, 1,331 million pesos, because they issued new Mexican peso debt in Q1. But at the same time, net income to equity holders jumped 16.9% to 6,211 million pesos, aided by a lower tax rate of 30.2%.
Yeah, down from 36.2% last year.
Right. And then they paid out a massive ordinary dividend of 4,065.1 million pesos. So my question is, they are taking on more debt to the point where interest expenses are climbing, yet they just paid out over 4 billion pesos in cash to shareholders. Is this just keeping investors happy, or is there a strategy here?
If we connect this to the bigger picture, it is a highly sophisticated optimization of their capital structure.
Okay, how so?
For a mature cash machine like KOF, taking on debt isn't a sign of distress. It's a tool. If you look closely, their interest income also increased because they maintained a higher cash position across key markets.
So they're keeping cash locked in local subsidiaries to earn high interest while issuing centralized debt in Mexico to fund the dividend.
Precisely. In volatile emerging markets, liquidity is survival. By issuing peso debt in Q1, they locked in favorable rates before things got worse.
I see.
They used that debt for capital expenditures, which exceeded 4 billion pesos this quarter for new trucks and coolers and to pay that massive dividend. Meanwhile, they leave their operational cash sitting in high-yield accounts in places like Brazil to buffer against economic shocks.
That is a very calculated, dual-pronged strategy. Use cheap leverage for shareholders, Keep the operational war chest full.
Exactly.
Well, that sets up our final segment perfectly. The off-balance sheet moves securing their future. There are 3 pillars: leadership shifts, digital integration, and ESG.
Right. Let's start with the leadership.
Yeah, they appointed Pamela Ortiz as Investor Relations Director, moving veteran Jorge Colazo to Strategic Planning Director for KOF Brazil.
Yeah.
So what does this all mean? Moving your veteran IR guy to Brazil right as it's breaking volume records is like a sports team sending their best coach to their star player.
It really is. It signals a shift from just chasing volume to demanding institutional-grade profitability. An IR director knows exactly what Wall Street demands: margin profiles, return on invested capital. By embedding him in Brazil, they're ensuring that 5.2% volume growth translates into actual valuation metrics.
Installing corporate discipline in the growth engine. Love it.
Yeah.
Now, the second pillar, the tech angle. They keep hyping their digital transformation and this Juntos Plus app. Is this just a corporate buzzword, or is it fundamentally changing how they distribute to over 2.1 million points of sale?
This raises an important question. For KOF, the Juntos Plus app is literally the central nervous system of their profitability.
Really, not just a buzzword.
Not at all. When you serve millions of tiny mom-and-pop shops, your biggest enemy is drop size inefficiency.
Right, sending a massive truck to drop off 2 cases of soda destroys your margin.
Exactly. Before digital, a rep physically visited the store, took an order, and a truck ran a static route. With Juntos Plus Star, the shop owner orders on the app. It feeds real-time data back to KOF, letting algorithms dynamically optimize truck routes and consolidate deliveries.
Oh.
Yeah, when Ian Craig talks about the affordability strategy working in Mexico or driving double-digit growth in Colombia, he's talking about this predictive logistics engine.
It gives them microscopic discipline. Okay, final pillar, ESG. They got the best total score in Mexico, CSA 2025, from S&P Global. Why does an ESG score actually matter to a beverage bottler's financials?
Because for them, it's a fundamental license to operate. They extract millions of liters of water and make billions of plastic bottles.
Right.
Institutional investors view water stewardship as extreme risk management. If KOF can't prove they are efficient with water and recycling, they face losing extraction licenses or getting hit with crippling plastic taxes.
That makes total sense. Securing that top score validates that their volume growth isn't compounding their regulatory risk.
Exactly.
So, to summarize for you listening, KOF is navigating a brutal obstacle course. Currency drags, tax hikes, home market struggles. But they're beating it through sheer scale, masterful supply chain hedging, the Juntos Plus app, and that booming South American market. If you want to understand how companies survive global inflation, this earnings report is a masterclass.
It really is an incredible display of resilience. But, I want to leave you listening with a final thought to mull over.
Okay, what is it?
We've talked a lot about how they manage inflation, currency, and taxes. But there is a looming physical challenge no financial trick can fix.
Water scarcity.
Exactly. As global water scarcity becomes a more pressing reality, especially in places like Mexico and South America, how will the world's largest bottler reconcile its need for record-breaking volume growth with the environmental and political realities of water access?
That is a tension no accounting trick can solve. Definitely something for you to keep a close eye on. And if you want to keep tracking stories like this, be sure to follow the show for our daily earnings coverage.